Good afternoon, traders and investors. Will back here with another one, coming to you with a Saturday video, guys. And it's that time of the week where we do these subscriber requests that we've been getting on the channel for the past week of trading. Now, in terms of today's video, guys, we've got a number of them to go through. As a matter of fact, roughly about 10 to 12 of them. So looking forward to see what you guys have prepared for me. Now, keep in mind, guys, if you want to have your symbol featured on one of these videos, just leave a comment with the symbol that you would like to see in one of my videos throughout the week, and I'll do my best to take a look at it in any given Saturday moving forward. Keep in mind, just to be fair to everybody, guys, please only do one ticker per person, just so everybody gets a chance to have their own ticker featured. So with that out of the way, guys, a lot to cover in today's video, so let's jump into some of the things that we want to look for when looking out for stocks. So always remember rule number one, guys, a stock's price is a reflection of future earnings and future cash flows. You want to see earnings and cash flows grow if you want to see the stock price go up. Number two, never chase a single stock, even if it's running away from you, guys. Let the market come to you. Don't forget, there's over 1,000 blue chip stocks in the market right now and over 8,000 stocks total. There is always an opportunity to be had. Now, a couple of the rules that we're going to be looking for here, guys. Number one, we want to be looking for companies that have a competitive advantage in the industry. If you are looking into a stock, guys, you need to be able to say, what is the stock's competitive advantage in relation to its industry in a second, right? You need to be able, if somebody asks you, what does the company do and what is its competitive advantage, you need to be able to say it. If you're not able to say it, guys, well, that is definitely a problem. Number two, if you missed a name, check the industry peers. This goes in line with not chasing, right? So if ever you missed a name like NVIDIA or whatnot, take a look at the industry peers to find if ever there's a company or several companies that are maybe lagging behind. Number three, we want to be looking for companies at big areas of technical support. Think daily, weekly, and monthly. Just gives us a better degree of entry and a better margin of error when we're entering at large areas of support. Number four, we want to be going for companies that have expanding revenue and expanding EPS. If you don't know what that looks like, guys, TradingView has a free tool right here, right? All you have to do is scroll down the company right here. Let's say for Microsoft, click on See Forecast down here, and you'll see this gorgeous uptrending EPS chart and this gorgeous uptrending revenue chart from Microsoft. That is what we want to see in a company. If it's all choppy, up, down, left, right, and center, right? That is not consistent and that is not predictable. So those are the things we want to find in companies, guys. Consistent and predictable EPS and revenue growth. Number five, you want to see if a company has good free cash flow. Once again, bringing up Microsoft example, just go down here in TradingView, click on the financials tab right here, and you will see their free cash flow is right down here, this middle column in blue. Are they bringing in a decent amount of free cash flow per year and per quarter, or is it very choppy? Once again, we want to find predictable and consistent companies in terms of free cash flow growth. And then lastly, guys, a company with relatively low debt, especially in a high interest rate environment, guys. We don't want to be going with companies that are over leveraged in debt, because that definitely represents a little bit of a problem. So the name of the game here is solid fundamentals, all of the above, plus a great technical entry. Think of large support levels. So with all that out of the way, guys, let's get right into stock number one, and we are going to take a look at Make It So. Can I analyze FBRT, Franklin BSP Realty? No problem at all. Trending down, but a high dividend. Absolutely. So let's pull it up. FBRT. So this one, classic REIT, guys, right? So this one, in terms of what they do, is they are a hard money commercial lender. They brand themselves as a REIT, but they do not own any of the properties. If you take a look at what they do in terms of all of their property listings, you will see that all they do is they provide loans. Every single one of these, and this is a very long list, right? All they do is provide hard money loans. What is a hard money loan? It is usually when a property cannot obtain normal financing with a traditional entity such as a large bank. They will go to one of your secondary lenders, also known as hard money. So usually the way these guys works is they make money on the spread. This lender right here can probably borrow near close to the risk-free rate at the Fed. So if rates are 3%, they'll borrow at 3% and they'll lend it out at 7-8%. If rates are 5 to 7 like they are now, they will lend at 10 to 11%. Now, keep in mind, when they are lending at these higher interest rate levels, it is very possible, guys, that the person that they're lending the money to, very possible that the property will barely, if any, have any free cash flow whatsoever on the property. So when rates are very high right now, even the loans that they issue are quite risky, because if ever cash flows turn negative and vacancy rates go through the roof, well, the person who borrowed the money may just default on the loan, and these guys may be left holding the bag. Now, if you guys didn't know, REITs are required to pay 90% of their income in terms of dividends, which is why you'll see for a lot of these REITs, guys, it is not far-fetched to see dividend yields anywhere between 9 to 11%. For any given chart that looks like this, guys, I can show you guys 10, 15 different REITs that have the exact same chart, virtually no share appreciation because they pay all their money out in dividends, right? And this one is exactly the same. They pay out so much in terms of dividends that you never get any cash capital appreciation. When you take a look at their financial statements, you will see that a lot of the money that they actually pay you in form of dividend is just return on capital. They are literally paying you your own money back, not in excess of anything that they made, which is why you get trends that kind of look like this on so many of these REITs. Now, that being said here, guys, right, the company is not a bad company. I would just be a little bit concerned because they're exposed to a lot of commercial lending right now at extremely high rates. So if vacancy levels go up, if tenants don't pay, well, then the company is left holding the bag. They have no skin in the game in terms of equity. They are only a commercial debt enabler, right? So that being said, guys, we obviously have a very large level of support down here. Very, very nice around the $12.50 towards roughly $12 range, which seems to be a decent location in terms of our historical support levels. However, in terms of share appreciation in the future, guys, it's going to be really, really tough. All of these commercial lenders that only employ debt in order to leverage essentially shareholder returns, they're not really in the business of shareholder appreciation. At best, they just want to maintain a roughly par value of their net asset value and pay off the cash dividends as best as they can. So all in all, guys, I'm not the biggest fan of this type of REIT, to say the least. Even though it could be a well-structured company, I just don't like the business model, not only in a high rate environment, guys, but as a whole. I want to see, if I'm investing in a REIT, I want to see a company with skin in the game. I want to see some equity, I want to see some appreciation, and I want to see some indexed rents to inflation. So a couple little examples that I'll give to you guys. One of my favorite REITs in the entire game right now is Vici Properties. I talk about it a lot on the channel. They don't pay an 11% dividend, but they do pay almost a 6% dividend, and they own all the properties that they manage. And more specifically, they're exposed to the casino and entertainment business. They own about 70% of the entire land on the Las Vegas Strip, right? Most, if not all of the, well, not all, but most of the casinos are owned by Vici Properties. Vici Properties was spun off by MGM Resorts a few years back. They are the landlord arm for MGM, and they index all of their rents to inflation. Such a strong company. Another type of REIT that I really like is what we call triple net lease REITs. So if you don't know what a triple net lease is, right? So, excuse me, let me just pull it up. This is one of the larger players in the game right now, EPRT. And there's another one, we'll go over it, ON, which you guys may all already know, right? Realty Income Trust. Essentially what a triple net lease is, guys, is when you have a tenant, right? What does the tenant pay for? What does the landlord pay for? Now, in traditional residential, you're maybe used to the landlord paying for everything and the tenant only pays rent, right? The landlord pays for sometimes utilities, property taxes, insurance, all that stuff, and the tenant pays for nothing. In commercial, it's a little bit different. So a triple net lease is a lease in which the tenant pays for everything. They pay for taxes, they pay for insurance, they pay for maintenance, they pay for utilities, they pay for the rent as well. The landlord does nothing except own the property and collect the rent. It is the best possible scenario for a landlord. So the companies that are operating in triple net leases, this is a very good one right here, EPRT. And the other very, very famous one, which owns a bunch of things like, like Walgreens, a bunch of different stores like that, right? All your commercial chains, they are the landlord to a bunch of these commercial chains. It's one of pretty much the industry leader in that respect. This is O. The stock symbol is O, Realty Income Corporation. And if you want another little swing trade that I do sometimes, another one that nobody ever talks about, which is also considered a REIT, which is a Public Storage, right? Public Storage, one of the largest players in the game right now in terms of what they do. They offer a very healthy dividend for 4% growth, and they also are growing very, very decently on a yearly basis, right? Decent EPS expansion, although it's not the fastest, not a tech company, right? And very good revenue expansion as well. They really dominate the North American market for what they do. So very interesting company. Hopefully you guys have a little bit more insight into REITs after this brief little 3-4 minute segment there. Thank you very much for that one. Make it so. Now, moving on to testing the waters. Can we review IMPP if I get a chance? Of course. Well, now we get a chance. We're going to take a look at IMPP. So IMPP right now, guys, right? Marine shipping company based out of Greece. I'll just be front and center by saying this company only owns four 4 vessels to transport oil and petroleum, right? Obviously not a very large player in the game. They're pretty much just starting. They had their IPO back in 2020 and 2021, right? What we have to be careful here, guys, is this is an extremely cyclical business. It's obviously, it will move with the price of shipping containers around the world, and the price of shipping containers around the world will move with 2 things. Obviously, during the pandemic and after 2021, well, things were moving because inflation went to the absolute moon and supply chains were disrupted because of the pandemic. Well, now things have kind of normalized, except for in the last couple of months since we've been having the whole episode in the Middle East with all the events in the Red Sea, which is making a lot of people take different shipping routes. So it's an extremely cyclical business which relies on these geopolitical events for pretty much to make or break the industry, right? So very small player in the game right now. They don't have a tremendous amount of revenue. As a matter of fact, their market cap is only about $100 million, and they bring in, roughly last year they brought in about $183 million. But the problem with this company right here is you can see diminishing EPS over the next couple of years is the forecast, and even revenue. Flat revenue, right? Just not able to break over and above. So what is this company's competitive advantage over and above its competitors? Can you tell me? Probably not, right? That is why I would tend to stay away from this company. If you want to play this company, yes, you can always derive that they do have a decent support area down here, 3.3 all the way down to $3. That's okay for a little technical setup, right? But we want to be focusing on the fundamentals of the company right now in terms of debt. At least they don't have any debt whatsoever. Decent free cash flow, decent cash and cash equivalents, but the company is so small, guys. And this one will basically be a byproduct of the industry. Take a look at your container shipping prices. I know this is not specifically for oil, but everything pretty much goes along with these prices, right? You can see this massive surge in 2022, normalized for a little bit, and now the Red Sea events is pushing it a little bit higher because of escalating tensions in the Middle East. So if you want to play this as a trade for the Middle East tensions, perfect. But just know, guys, the Middle Eastern tensions will not last forever. And when they stop, this trade will have the rug pulled out from under you. Look what happened to Zim. Zim is another marine shipping company, right? Tremendous rally in 2022 and now completely crushed, even though they have had a little bit of share appreciation ever since the Red Sea events, right? But the number one that you want to keep an eye on, guys, is Maersk. They are the largest shipping company in the world. You have to keep track of what this company is doing. If you're looking at playing beta plays, as we call them, right? This is the alpha play. All the other plays are little beta plays. If you want to play the beta plays, you have to keep a very close eye on what this company is saying during its quarterly financial statements. So hopefully that was helpful for IMPP. I apologize, I can't provide more insight than that, but hopefully all of that was clear. Now, number 3, can we do a quick recap on Redfin and Shop? Now, guys, I will do 2 just because I wasn't here for about, we didn't do last Saturdays. So I'll get these all out of the way. But in the future, guys, please just do 1 per person. I would really appreciate it, right? So like Investments 11 asking, can we do a recap on Redfin and Shop? Yes, I'll do these quickly just because you have 2 tickers, but no problem at all. So Redfin, everybody knows what Redfin does, right? They operate, not only do they have that website that shows you home prices and everything, but they do mortgages. They have a real estate agent team. So obviously they make commissions on properties that they sell and everything. But the problem with Redfin, guys, is undoubtedly the financials. The financials for this company are just not very good. You can see net margins, very inconsistent. The company is losing money for the last couple of years. Normal, because the housing market has really slowed, right? So take a look at EPS. This company is not slated to be profitable for another 4 years. And revenue has significantly declined since the housing boom in 2020 and 2021. Going to be recapturing a little bit of that, but you can see the revenue growth is not amazing, right? It is there, but it's not amazing. The company is still relatively small, really being challenged down here at pretty much the all-time lows of the company, about $6, right? So when I take a look at this company, you have to take a look at your competitors and what competitors are doing as well, right? So in terms of it not being profitable, that is problem number 1 with me. If you want to take a look at their competitors, guys, take a look at Zillow, their direct competitor, right? Zillow is in the exact same situation. This is an extremely cyclical industry, which is going to depend on the on the resurgence of the housing market. That, guys, is not going to happen until rates come significantly down and you have some inventory buildup. That is going to take some time. So if you want to make a little bid play on Redfin, right, down here in the mid, let's call it 550 all the way down around roughly $4 as a, kind of as a, let's just call it a speculative gamble, that would be fine. But this is not one that I would be adding to the company because of its fundamental prowess, right? It would be pure speculation trade at all. I usually don't take these, but then again, none of this is financial advice to you, of course, right? So you take a look at Zillow. Other ones that we could take a look at here, guys, undoubtedly has to be Remax. Remax is a very big one in terms of just the agent nature of the business. And you can see Remax in the exact same situation, completely destroyed. Now, if you want to take a look at one that is a very solid company in terms of fundamentals, instead of going with the retail housing market, let's take a look at what happens in commercial and the industrial market when the company is efficiently managed and goes for net profit margin expansion. Take a look, guys. This is CBRE, Coldwell, one of the largest players in the entire game, guys. This company is absolutely fantastic, right? Growing revenue, decent profit margins. You can see that right here, decent profit margins. Although they're slim, they are in the real estate game. The margins are not supposed to be that wide to begin with, but they are net profit margin. They're net margin profitable right here. And you can see coming back, even though they did have the similar thing in 2021, 2022, in terms of the real estate property boom, now they're coming back to net growth 2024 onwards. And look at this consistent revenue. This is what I want to see in any given company, right? So this has to be my top pick for anything exposed to real estate, the business of buying and selling real estate specifically, right? So hopefully that's helpful. Hopefully that's helpful for you. And then lastly, Shopify. Let's go over Shopify. We've done this one quickly. We actually covered them. If you want to go through my videos, we actually covered them last time they had earnings in the month of May. We went through them again. But if you want me to do a quick recap, guys, company finally profitable, doing good cost management, free cash flow positive, which has never been the case, low amount of debt, industry leader in what they do. However, guys, consumer discretionary slowdown, right? This is predicated on this entire business is predicated on small businesses being able to grow by selling cheap things to consumers. And so far, guys, unfortunately, it is not the best market environment for them, even though they do have a high EPS growth and high revenue growth, and their PEG ratio at $62 is relatively okay. The company is currently not in the most favorable macro environment for them, but I have to give it to them, guys. The company is finally EPS profitable and growing. Revenue is growing nicely as well. So this company is definitely on a nice recovery story. I really don't see any problem building a position down here if you like the company and you're looking for that eventual market share recapture, which should happen when consumers have more disposable income, except for, if we're expecting, it may not be this, but could we have just a slow grind higher back to the all-time highs on Shopify over time? Absolutely, guys. But as I said, it may take some time. Now, number 3, let's go over for Lee Sutton asking, can I do DKNG and SYM? No problem at all. So let's go over DraftKings. So DraftKings, we're going to take a look at it, guys. DraftKings has done a very good job, guys, in the most recent years of really becoming a profitable or near profitable company, right? Well, they're trying their best, right? You can see a few quarters, they're barely almost close to being net margin profitable. Still nothing as of yet, though. And in terms of debt, they don't have that much debt in terms of cash and cash equivalents as well. So the balance sheet is relatively solid. Now, in terms of the EPS growth, you can see finally 2025, EPS will be positive. This is going to be huge for the company because it has never been the case. So we're really in for a company shift in terms of profitability. That's going to be good and very nice revenue expansion for the company as well. They're pretty much the industry leader over and above a company like Penn. So I do think DraftKings is not that bad of a bet. Let's take a look at the revenue growth, 15% a year, EPS growth, 59% a year. That's very, very good. It seems like a high number, guys, but they're starting at 0, right? So they have to ramp it up, which gives them a 2025 forward P, 2025, not 24, because 2024, they're still negative for this year, right? But 2025, next year, at $39, gives them a forward P of 71, which at a first glance seems high. That's why we divide it by the EPS growth rate, and it gives us a PEG ratio of 1.2. That's actually not too bad. Couple that with the fact that we're coming up on very decent area of support down here, guys. Pretty much $34 down to $29. If we do revisit this location right here, I don't really see any issue with starting a position on DraftKings. Just understand the risks of the position. The risks of the position, guys, is litigation, right? So obviously you know that gambling is not legal in all 52 states in the US. Yes, there's being significant progress made on that front, but until they have exposure to the entire North American market, they will not be able to grow the way that they want to grow. So just understand the risks with this company. One of the other gambling stocks that I'm personally invested in is this company right here that nobody ever talks about, EVVTY, Evolution AB. Essentially what they do, guys, is you may have gone online, right? Whenever you go online to one of your favorite casinos and you see these online gambling rooms, blackjack tables, roulette tables, poker tables with live dealers. Do you ever wonder where those live streams are coming from? They're coming from this company right here. They pretty much have a monopoly on this entire industry. Almost all the casinos that you can possibly think of run through this team right here to set up services for them where they'll have, employees wear MGM shirts and stuff like that, but they're not really MGM employees. They are from this company right here. So they're pretty much a middleman for online games like that, right? So they provide that type of experience for a lot of casinos customers. And for that, they're rewarded handsomely. Take a look at, you like net margins? Take a look at these net margins. 55 to 60% net margins. Extremely solid company, guys. Take a look at your EPS growth. Beautiful EPS growth, beautiful consistent revenue growth as well. And technicals looking very, very good. Just a tightening range, looking for the eventual breakout. And with those fundamentals, guys, should be breaking up pretty decently. PEG ratio around these price is about 1.6, not that bad at all. So this one is definitely in for a second look if you like that type of casino and gambling plays, right? So now moving on to SYM, the second one. So let's take a look at SYM, guys. So pulling up SYM. So SYM, what they do, if you guys don't know what they do, I've seen this company now for not a long time, right? Pretty much for the past 2 years. What they do is they do pretty much manufacturing processes. Think when you have a warehouse that has a supply chain, right? Let's say you're building cars or you're making Coca-Cola bottles or anything. It goes through a bunch of machinery processes, right? From making the bottle to putting the liquid in the bottle to putting the wrap on the bottle, everything like that. That is pretty much your production line, right? So this company is in the business of manufacturing those production lines, and they're using AI to make them extremely quick and extremely efficient. So very, very new company per se, and seems to be very good. One of their largest shareholders right now is Walmart. Walmart has a very big stake in the company. In terms of the company, guys, in terms of the financials are really not looking too bad. It's a very early company in the early stages. No debt to speak of, right? A lot more free cash flow than debt, a lot more cash on the balance sheet than debt. So the balance sheet is fine. Take a look at EPS expansion. EPS expansion is slated to be really, really good. They were net negative all through about pretty much this year, and now they're finally EPS positive, growing nicely, and revenue is really growing nicely as well. Great expansion by this company. In terms of the technicals, guys, technicals also looking pretty good. I see no reason to not be able to start a position in this lower area of support, 34 down to 30. Seems as though the market really likes to hold the stock up right here. And at that price right here, the valuation is not too bad. Growing revenue and EPS extremely strongly. This EPS number will not last forever. It's just because they're starting from zero, right? Eventually that will taper off, but at least for the next 3 years, 113% is the average. So that being said, their forward P at $35 is about 166. At a first glance, this seems extremely high, which is why we divide it by their EPS growth rate, gives them a PEG of 1.47. Not too bad. Anything between 1 and 2 is okay. Above 2, slightly expensive, and below 1 is a very decent deal, provided the company is still growing, right? You don't want to get trapped in a value trap per se. Now, if you like this one, guys, the number one thing I would be doing in terms of figuring out whether or not this company is going to be able to grow higher and higher and start gaining market share from some of your industry leaders, $3.6 billion market cap, not too bad. However, check these as your closest competition, right? These are pretty much the industry leaders. So NDSN, if you guys don't know this one, Nordson, they are pretty much the industry leader in what they do. Just think production line robotics, right? Look at this absolutely ridiculous chart. The fundamentals also are very good. So let's bring it back to the one we were on right there. Excuse me, SYM. Have too many tickers going on right now. And the other one that you may want to look into is DOV, Dover Corporation. I've known this stock for a very, very long time, and the market really appreciates this one as well. Both of those companies, guys, have extremely higher market caps than SYM specifically. So the crux of the argument right here is to derive What does SYM do better than the industry leaders? Will they be able to continue to gain market share? And that is what you're going to have to build your investing thesis on. All in all, everything else though, technicals looking decent, valuation looking decent, and the fundamentals looking like they are expanding. So thank you very much for recommending SYM for us to take a look at. Now, GB asks us, can we please take a look at AEHR? No problem at all. Let's have a look. So AEHR, so Air Test Systems. Now, I saw this one last year when a bunch of people were playing it on Reddit for the substantial run-up, claiming that it's going to also benefit from the rally in semiconductors. Now, what this company does is they test semiconductor equipment, right? That's all they do. They manufacture machines that test semiconductors either for breaking points, heat breaking points, or just overall general tests to figure out if the semiconductor chips are being manufactured correctly, right? So they manufacture testing equipment, namely for silicon carbide chips. That's their number one business. So they're incredibly dependent right here on the EV market. Why? Because 80% of their entire revenue comes from one single company, ON Semiconductor. So if you're wondering why is the chart been collapsing like this over the last 12 months, well, take a look. Their main business, guys, has also been doing the same thing, or their main customer rather has been doing this, right, for the past 12 months as well. So no secret there. That is why pretty much AEHR has not been performing, because of their close ties to ON Semiconductor. Now, in terms of the company's financials, guys, the company's financials, they're okay. Now, they used to be an unprofitable company. Now they finally turned profitable. They had a little bit of a mishap last quarter here, guys, but that cannot become a trend, or else it's going to become a problem for the company, right? So in terms of net profitability, it has been improving. And in terms of their balance sheet is fine, much more cash than they do have debt on the balance sheet. The problem arises here, guys. The problem is inconsistent EPS. Look, just so inconsistent, very inconsistent, which is why I just don't like investing in businesses like this, right? So moving on, inconsistent EPS growth, and also very inconsistent revenue growth. It's just not consistent. It's not predictable. It relies heavily on one single customer. So in my opinion, guys, this one will truly only recover when we have a recovery in the EV market, which is slated to be pretty much in the years 2025. That being said, if you're looking for a technical entry, this one does seem pretty good, right? In terms of the monthly is not looking too bad right here. So in terms of the monthly, guys, right? Monthly, big previous area of support right down there. And the 200-month moving average is right down here at about 865. So it could be a nice little position if you are truly bullish on the company. And if you have some alpha that nobody else has, then maybe this could be a good trade location for you. But for anybody else, guys, you know, when I see a company that's so inconsistent, right, and is so reliant on just a few things for its expansion, it's never a good look for a company. My favorite company that manufactures the machines for semiconductors has to be undoubtedly ASML, right? ASML, they are the monopoly. If you guys like picks and shovels for semiconductors, they are the company that manufactures the machines that makes the picks and shovels. They have an absolute monopoly. Nobody else makes these machines, these advanced lithography machines, right? Valuation up here on ASML, very decent at 1.51. This company has none of the problems that we just saw, right? Very consistent EPS growth, very consistent revenue growth as well. Just a more mature company to say, right? So I understand why a lot of people look at the smaller companies like these, because you guys are obviously looking for 5 baggers, 10 baggers, right? But the fundamentals need to support that. If you are not going to see a 5 to 10x on EPS, the stock price is not going to 5-10x. That is just how it works, right? So thank you very much for the recommendation. Now let's move on to PO Box. So this is a little bit of a, so one thing that I put them all down here just so I'm not going to forget you guys, right? So we had a couple guys ask for some energy plays, electricity and nuclear plays. Why? Because obviously with so much demand for AI, new data center construction, and robotics in the future, well, the price of energy is going to go up, not only natural gas, but also think electricity and think nuclear powered electricity too, right? So we've had a lot of requests, PO Box asking VST, CEG, NRG, TLNE, energy, comparison video. We have a few more down here, right? We have testing the waters, asking for that as well. Energy sector plays, Enphase, Nextera Energy, FSLR, then Roman as well, asking CEG and VST. So what I'll do, guys, since there's a few of you asking me, I will film a completely separate video on energy tomorrow, where I'll go through the top 5-6 players of pretty much the energy industry right now and what could be the potential impact on the energy grid as a whole and how those companies stand to benefit, just because there's a lot of them right now. So I'd rather figure I should do a separate video on the topic as a whole, because it's definitely going to be one that people are not that much talking about as of recently, but could be a very booming industry in the future. So hopefully you guys understand. Now, let's move on next. So that'll probably be tomorrow. I'll be putting that one out tomorrow mid-afternoon, right before the top 5 options plays videos. Now, moving on to DK Explorer. So DK asking us, pick for Saturday is Johnson & Johnson. No problem at all. Johnson & Johnson is one that I often play short puts in this range right here. So Johnson & Johnson, I mean, the company needs absolutely no introduction at all, right? So in terms of Johnson & Johnson, you guys know how many companies, how many businesses this company runs, right? The pharmaceutical, consumer goods, medical devices, consumer health, all of these products, Band-Aids, Pepsids, right? Vision products as well, AccuView, skincare, Rogaine, Neutrogena, Aveeno. This company has so many different brands under its arm. However, we need to see if it's currently at a good valuation, right? Company's been pulling back for all intents and purposes for about a year at this point, year and a half, and pretty much stuck in a range since pretty much 2017, 2018. So why has it been stuck in a range? Let's have a look at the fundamentals here, guys. So let's take a look at first. We're going to go through their financials. How is the balance sheet? The balance sheet is pretty decent, guys. Not that much debt in relation to cash and cash equivalents and the amount of free cash flow that they generate. The company also has fairly decent net margins, guys, always between 15 and 22% net margins. That is very, very decent. And they use it to pay out a decent dividend as well. The company pays out about a 3.39% dividend, and they do share buybacks, although it's not a majority of their business right now. Take a look at EPS expansion, and you will see why the company has been relatively flat. They have been stuck around $9 to $10 EPS for 4 to 5 years. Now, this is supposed to be improving into 2024, 25, 26, 27, supposed to be improving, but you can see the growth is not very much there anymore. It's a very mature company, right? Revenue as well. Take a look at revenue. Revenue largely, for all intents and purposes, flat since 2019, 2020, right? Roughly between, let's call it, the mid 80s. They had a little bit of a bump here, 2021, 2022, and then 2023 back to mid 80s, and now still high 80s, finally growing into the 90s, later 2025, 26, 27. So this company is not about revenue expansion or about EPS expansion. It's a very mature company as a whole, and they're just looking to retain market share. So that being said, guys, in terms of the valuation right here, you can see that 2024 PE at $146 is about a 13.73. That seems cheap at a first glance because the company isn't growing, right? They're not going to put a 2030 PE multiple on this if the company is not growing. It is not a tech stock, right? That is how Wall Street does valuations. Now, when we divide this seemingly cheap PE ratio by their EPS growth ratio, you will see that their PEG ratio is 2.64. That is actually high. That is actually almost twice the PEG ratio of a stock like Facebook, right? Just to give you guys an idea. So that being said, the company is relatively expensive. It is coming into a very nice area of support, and I'm not opposed to playing short puts in the lower $140 range. That will be fine, even if it's close as $130. I would really like this company, if I can find it in the 130s, that would be fine to make a little bit of a swing trade on it. But in terms of a long-term investment for the company, is it a solid company? Sure. But in terms of a long-term portfolio investment, I don't believe that Johnson & Johnson will be a market outperformer. We're looking for market outperformers, right? What could be some of the market outperformers in healthcare that we're looking for? Because this one is in the healthcare industry. Let's take a look at some of their peers, right? So number one, Merck. Take a look at Merck, right? Very, very different contrast. If we take a look at their fundamentals, guys, you will see the contrast, right? Expansion in EPS, clear expansion in EPS, and clear expansion in revenue. That's just number one. If we want to take a look at a competitor number two, they're not direct competitors to Johnson & Johnson, just in the same industry, right? We're looking for the best companies in the healthcare industry. Take a look at AbbVie as well, right? Take a look at their fundamentals, guys. EPS, although they have come down a little bit, going to resume trend. Very healthy EPS expansion, double-digit expansion, and also coming into double-digit revenue expansion too. So that's pretty much it for AbbVie as well. Take a look at competitor number three, HCA, right? The guys that own most of the hospitals in the United States, and just such a powerhouse company, guys. Take a look at their fundamentals, right? Fundamentals, that's why we look for expanding EPS and expanding revenue as well. If you get expanding EPS, guys, that's what lets you have a share price expand, right? If you have flat EPS like Johnson & Johnson, That's why your share price is not expanding. And the last one, UNH, the largest healthcare provider or insurance provider in the United States. Very, very stable chart. For all intents and purposes, guys, this is almost a monopoly. A bunch of other companies does this, but nobody comes even close to the scale that UNH operates at. And take a look. EPS expansion and gorgeous revenue expansion as well. So if you're looking for share prices to continue to rise, you need to see a chart at which EPS is continuously expanding. And unfortunately for Johnson & Johnson, even though it's a very solid, very defensive company, the growth is just not there, which is why the share price appreciation is also not there. So that's pretty much it for them. Now let's take a look at the next one from Lori. Thank you very much, Lori. Take a look at SMCI. Yes, we take a look at this one. Obviously, guys, we've taken a look at this one a lot in the past couple of weeks, but let's go through it again. So SMCI needs no introduction, right? They pretty much manufacture server racks and cooling solutions for companies like NVIDIA when they want to put, let's call it 10, 20 different GPUs in a server rack, have it all cooled and powered and just put it in a corner somewhere. This is the company that manufactures those racks and cooling solutions. So in terms of them, guys, I mean, the fundamentals of this company are absolutely amazing, right? So number one, no real problem with debt whatsoever. They are flush with cash. Balance sheet is very, very gorgeous. No problems with debt whatsoever. Tremendous free cash flow. Very, very decent cash and cash equivalents position as well. In terms of EPS expansion, look at this crazy EPS expansion over the next 3 years. Very nice revenue expansion over the next couple of years as well. But as I've said with all semiconductors, be very careful because late or mid 2025, that is the time where the growth is going to start tapering off. So is there juice left in this play? Yes, probably. Can it retest the all-time highs? Yes, probably, but be very careful come the midpoint of next year. That being said, I really like SMCI, guys. Down here, as you can see, just a very tight monthly consolidation range. You can argue that it is still in a monthly uptrend, looking for the monthly higher low. Anything above 745, looking for the monthly higher low for furtherance of the trend expansion. I like this company. It's been consolidating here for a while. If I can see it pretty much with a 7 handle in front of it, think maybe 780 all the way down to 750. That is pretty much a screaming buy, as it was pretty much at the early part of June, and then they had a tremendous rally. So I like this one a lot, guys. The PEG ratio is not that bad either, right? Very decent revenue and EPS growth. In terms of the forward PE, we did this at 770 right after their earnings. It's very close to that. Maybe it's about 5% over that right now. So we can, these numbers might change a little bit. Their PEG ratio right now is close to 1. Close to 1 for such a company that's growing extremely quickly, guys, is very, very good. So this company is a very solid bet, and I personally will be playing this one as I have on the channel. If we do retest this level right here, guys, as part of more semiconductor consolidation in the next coming weeks, I will be playing it 770, 750 is my personal desired target for entry. But if you just want to build a small little position right here, I really don't see any problem in starting a little bit of a share position right here. If you don't want to wait for this larger support area, no problem at all. Just keep a very close eye on the overall semiconductor industry growth, right? Because that will be the one that's affecting this company the most. Thank you very much for that one, Lori. Now, Prakash, if you have time, can you check ARM and C3AI? No problem at all. So let's do ARM. So as I said, guys, one ticker moving forward in the future, but obviously since I wasn't here last week, I'll do 2 for you guys just because I'm so generous, right? So moving on to ARM. ARM's extremely, extremely solid companies, guys. Probably you guys know that it needs no introduction, right? They don't actually manufacture any semiconductors whatsoever. They just design the semiconductors, and then they sell those designs to other companies that do manufacture them. And then not only that, when the other companies use those designs, this company collects royalties forever and ever, as long as people are still using their designs. So very, very profitable business to be in. As a matter of fact, net margins, very, very decent. For the most part, they're always in excess of about 20% when the business is really doing a good job. In terms of EPS expansion, you guys can see very nice EPS expansion, very nice revenue expansion. The company's not new, even though they just IPO'd. This company is about a 15, 20-year-old company in if I'm not mistaken. And in terms of their financials, guys, company has no problem at all with debt. Look how much debt they have. Almost nothing in relation to the free cash flow and cash equivalents that they have on their balance sheet. So very, very solid company. The only problem that I have with this one is the valuation. Now, if we're looking at a little bit of a technical entry, very, very quick right here. Prior all-time high, resistance could be newfound support, and that's pretty much all the way down 152 down to 140. So this would be an area where I may be looking to make maybe a swing trade entry down this lower range right here, that could be the juicier location, in my opinion, if we're looking to make an immediate trade, looking for that weekly higher low for the eventual trend continuation. Same thing on the monthly, right? Beautiful monthly trend expansion. So the trend is definitely up, just waiting for a little bit of a pullback and being greedy. But why am I being greedy, guys? The valuation right now is just too darn high. We did this valuation when we were at the earnings. When it was $100, it was a screaming buy. And as a matter of fact, that's what I was saying on the channel at that time. But now at 163, guys, a little bit high. Even though they do have very good EPS expansion, PE ratio at 163 is 105. First glance seems high. You divide that by their by their EPS growth rate, gives us a peg of 2.62, which, even though it's a semiconductor company, even though it's a high growth company, guys, it is very, very, very high, right? Take a look at SMCI. SMCI, for all intents and purposes, is closer to the all-time high. Look at their PEG ratio, right? So ARM, a little bit high. As a matter of fact, this is actually more expensive than NVIDIA. So take with that what you will. That's pretty much the analysis for ARM. I do think that there are better valuation-wise companies in the whole semiconductor industry. You don't need to look further. Companies like ASML, companies like NVIDIA, even I believe we went through Broadcom's earnings, as a matter of fact. We went through Broadcom's earnings just a couple weeks ago, right? And even their PEG ratio at $1,700 all the way up here was only a 2.04. So ARM, one of the more expensive companies in the industry right now at a 2.62. And now lastly, take a look at C3AI. So C3AI, this company, I swear to God, guys, it's not to say, it's not to be negative towards the company or anything like that, guys, but the only thing that this company does in terms of AI is having AI in the ticker symbol, to be quite honest with you. So in terms of that, guys, in terms of the fundamentals of C3AI, if you don't know, this company IPO'd at an extremely high valuation and thereafter just got crushed. And to be honest with you guys, they just don't have a clear core business proposition or competitive advantage. They just don't. As a matter of fact, right? So Prakash asking me the question, I'll be very honest with yourself. Can you tell me what C3AI's competitive advantage is? Can you tell me what their product line is? Even you go on the website, guys, the website, it lists very, very detailed product descriptions and whatnot, but the use case of those products is sometimes a little bit cloudy. Now let's take a look at some of their fundamentals, right? So their fundamentals, company is just losing money hand over fist. As a matter of fact, their net margins are arguably getting worse as time goes on. Not what you want to see from a company. That being said, they have been able to maintain a decent amount of relatively low debt. And the reason that they've been able to maintain low debt while losing money is because of share dilution. They just keep issuing shares and issuing shares and issuing shares to raise capital for the company. That is a very normal thing for a company to do, but obviously it dilutes the shareholders. In terms of EPS expansion, take a look, guys, not slated to be profitable until 2026. So still a few years of unprofitability for the company. In terms of revenue is expanding in a decent fashion, but the multiple on this company is still high, even though it's crushed, guys. 3.5 billion market cap, and last year they only brought in $310 million. Price to sales of over 10. That is very, very high, even for a growth company. So that being said, guys, definitely not one of my favorite picks. If you have to go with an industry competitor, guys, right? This company, it does a number of things. Number one, it tries to offer AI solutions in terms of security. Now, a number of cybersecurity companies just do a lot better than this company, what they do. Palantir is the first one that comes to mind. Palantir, a much better business model, in my opinion. Another thing that this company does is they do client relationship management models, the leader of which is Salesforce. Salesforce does a lot better job than this company at client relationship models. So a lot of the business models that this company is trying to attack, it's attacking about 4 or 5 different business segments, but it's not the industry leader in either one of them and has no clear competitive advantage over its industry peers in any one of them. So that is just my analysis on C3AI. If we're talking about pure technicals, and the only reason this one ran, guys, is because it got caught up in the AI ramp. So if we want to take this one on a pure technical analysis basis, guys, well, obviously 23 down to about 17 is your broad area of support. If you're looking, I would be looking for short-term oversold conditions, potentially daily oversold. As you can see, whenever we get severely daily oversold conditions leading into this area right here, could be due for a little bit of a swing trade opportunity. So that is the type of thing that I'd be looking for. If we come into oversold conditions on the daily coming into this location right here, could be due for a little swing trade. But long-term portfolio, Just wouldn't be for me, but obviously not financial advice to anybody else. Now, moving on. So testing the waters again, can we have one? This is going to be for the energy sector, so we'll save that one for tomorrow's video, but I just wanted to put it. Roman as well. I got you there, brother. I will take care of this in tomorrow's video. No problem at all. So Chingy as well. Can we do CEG? Tomorrow, we're going to cover CEG as part of their energy plays. So just to show you guys, I wanted to put you guys here just to let you know that I did not put you guys to the side. I know the request is there, and I'll be making a detailed video, probably about 40-45 minutes on the whole energy industry as a whole. Now, TradeWise asking, can we do TDW? Now, here's one that I haven't heard since my first year at the bank because of what happened to the stock price. Leading into this. This used to be a $100 billion company. What they do is, once again, we have a marine shipping company. Now, this company operated in several markets, depending on geography, right? They were in Latin America a lot, South America. They were in off the coast of Africa as well, the Middle East. So they've done business in a lot of places. They used to, at one point, have over 260 ships as part of their fleet. And now I believe their fleet is only about 10 to 15 ships, if I'm not mistaken, right? The problem with the company back in the day, guys, is they were just way too over leveraged with debt. And when banks started calling in the interest payments on that debt, the company was not able to pay. As a result, their EPS got absolutely destroyed. As you can see, positive EPS. Oops. EPS collapsed because their debt got called in. The company wasn't able to pay. They had to liquidate assets. Not only did they have to liquidate assets, but they had their assets nationalized by Venezuela. $45 million in assets. I remember it as if it was yesterday. $45 million in assets off the coast of Venezuela, nationalized in an instant by the Venezuelan government. You can't do anything about that, guys, right? Same thing that happened in Cuba in the 1960s. If a country wants to nationalize all assets on its territory, that is just the price that you pay for trying to do business over there. So very unfortunate fall off by that company. Now we're in a much different place. The company is trying to turn its business around. As you can see, we're finally back to net profit margins. The company also right now doesn't have too much debt, but it is running 3 times the amount of debt that it has in cash and cash equivalents. And it is a very cyclical business. As we were talking about for the previous one that we talked about on the channel, marine shipping, guys, extremely cyclical and extremely dependent on geopolitical situations. So take a look, decently expanding EPS. So they do have expanding EPS coming in the next 3 years. Very decent EPS numbers as a whole, and also in terms of revenue too. What they're doing to get a massive boost in EPS here, guys, it's kind of a fake boost. They're buying back a lot of shares at the current time, right? So revenue expansion is slated to be decent as well. And a lot of analysts have price targets in this one in the low to mid $100 range. That being said, let's forget all about the company history and start focusing on what's happening right now. So if we take a look right here on the technicals, guys, technicals not looking bad, right? It's a very clear uptrend right now. If I had to, right? I'm not saying that I want to, but if I had to take a position on this company, seems to be like a good area for a little bit of a swing trade would be down here, maybe in the that's maybe a little bit light, right? So maybe 85 all the way down to roughly $75 could be a good first level attempt for a position in this location right here. If in the event we come back for some extended downswings right here, let's say we are met with maybe oversold daily conditions leading into this area right here, could be a good location for a little bit of swing trade. Look at the 200-day moving average down here at $80 as well. Could be a nice little swing trade opportunity for the company. Now, in terms of the fundamentals, guys, just to recap the fundamentals. So revenue growth, very good. EPS growth, 54% per year because they're coming off zero, right? And expanding well and buying back a lot of shares with the cash that they're generating. That being said, forward PEG ratio at $95 is only a 0.33. Now, this is because, guys, Wall Street knows what these companies are and how these companies operate. They know it's a very cyclical business. So even though you see a very cheap PEG ratio right there, because the company is not consistent and predictable, because it's in a very cyclical business, they are hesitant to bid the share price up to a 1 peg, which would be closer to around the $240, $250 range, right? So you have to be very, very cautious with these types of companies. As I said, if the price of these containers starts coming down significantly, if the ordeals in the Middle East solve themselves, this price is going to collapse similar to what it did back here. We're going to revert back to the norm, and this company is going to be making a lot less money than it is right now. So keep a very close eye. It is cheap only if the growth estimates are real, and because it's such a cyclical industry, you can't really bank on the growth estimates. So the estimates are there, but they are only estimates, and they're not very predictable estimates, right? But if they're true, yes, it's cheap. But if they're not, be very cautious with a type of company like this, right? So moving on to Alejandro. Thank you very much, Alejandro. So I would love to hear your analysis on Med. No problem at all. I haven't heard that one in a while. So let's take a look at Medifast. So Medifast, guys, if you don't know what Medifast does, take a look here, guys. Medifast is a diet solution company. They were very, very popular prior to the pandemic and even during the pandemic as well. Essentially what it is they have a bunch of different food products that you can order on a monthly subscription basis. And it also comes with not only a dietary plan, but also a exercise plan too, right? So they try and couple a very good diet with very active lifestyle. That is the motto of the company. Now, how is this business structured, guys? It is an MLM business model, multi-level marketing. It is predicated on coaches. So coaches get into the game with them, and then they start at the ground level right here as someone who needs the service. Then when they've been on the service for a while, let's say you are on the service for about 6 to 12 months and your body shows a lot of changes, your diet's improving and everything like that, and you start losing weight, you start getting more healthy, start having a more active lifestyle, then you can graduate to what's known as a coach. You can then onboard other people into the business, and if they are onboarded by you, you get a percentage of their subscription revenues, right? So multi-level marketing, and obviously the pyramid goes down and down and down and down, right? So very, very decent business model in terms of personal health. The problem with this company is Ozempic, the weight loss drug that was approved by the FDA about 1.5 years ago, right? So take a look, this company was doing fine up until January of 2022. Why? Because Novo Nordisk, right? Here you go, right? Where is January of 2022? Right about here. Here's when the drug approvals were underway. And then boom, Ozempic hits the market. Novo Nordisk goes to the moon. Who also has a drug like Ozempic? Eli Lilly. Take a look at Eli Lilly. January 2022, pending drug approvals. Boom, Ozempic. Right? So that is the reason for Medifast's decline. And it's very unfortunate, guys, because this is the trade-off between dietary and lifestyle change, which arguably more, you would think that more people want this, right? But don't forget, guys, people are lazy. People are very, very lazy. They would rather take easy drugs to lose weight rather than going for the entire dietary and lifestyle change. People want results, and they want results fast without putting in too much work. That is just the nature of the human race for the most part. I'm not saying everybody, guys, but can we at least agree 75, 80% of people are like that? Maybe you're not like that, but 75% of 80% of people are like that. And the market responded, right? So you've had a net decline in sales. And unfortunately, the company is just very, very in a very, very tight spot right now, right? So in terms of the valuation here, guys, right, we have declining revenue, declining EPS. Yes, the valuation on price to sales is fairly good at 0.25, 0.3. That is very, very cheap in terms of price to sales, right? But the problem is as follows. In terms of the financials, they do still have a decent amount of free cash flow, do still have a decent amount of cash equivalents, and not a lot of debt on the balance sheet whatsoever. This company is only worth right now about $238 million. It used to be a $1 billion company, right? It used to be about a $2 billion company, 2.5, almost $3 billion company from what I remember at the peak right here. Unfortunately, it has really come undone here, guys, and it is nothing but the problem of the easy drugs, the Ozempic drug, right? Take a look at your EPS and revenue expansion, right? So EPS just got absolutely crushed, right? And even 2024 is slated to be a very, very bad year for them. Just can't get it done, guys. This company used to, at one point, they used to pay a dividend. Unfortunately, they had to cut the dividend as well. So they used to be bringing a lot of money for the shareholder, guys. But unfortunately, those shareholder gains have all but disappeared. And you can see this consistent decline in revenue over the past couple of years. They were really doing good, guys, really, really doing good. And now revenue set to be on a little bit of a decline. So unfortunately for this company, guys, it's nothing that the company itself did wrong. Nothing that management did wrong. The business model, you can argue, yeah, it's an MLM, but the MLM service was working very, very good so long as the business model was not offset by competition from a completely, not completely different industry, a connected industry, but something completely different, right? Either the dietary lifestyle change versus the easy drugs. Unfortunately, this seems to be the winner in this modern day and age. So unfortunately for me, I would not play Medifast just because the whole premise of the business is being disrupted by this, right? Now, The one saving grace for this company may just be a time and place if, for whatever reason, there are adverse effects from these drugs whatsoever. So far, no, but you guys know we need to see the long-term effects of these drugs, right? If ever these drugs, for some which reason, have adverse side effects or whatnot, then we may see a recapture of more dietary and lifestyle brands of businesses such as Medifast. The true test for Medifast will be if they are able to really uphold the amount of cash flow required to keep running the business. So yes, normally you would want to buy a business when it is absolutely crushed in terms of share price like this. Usually this is when, if you like the company, you should be buying shares. But as I said, guys, it is somewhat of a risky proposition, a bit of a speculative bet. Usually speculative bets can bring in lopsided returns, but what you need for this trade is you need a complete collapse of this right here, right? And so far, that is not happening right now. In terms of our technicals, guys, clear monthly downtrend, clear weekly downtrend. This thing has been oversold for so many weeks in a row. It's just not respecting the technicals, guys. It's basically just investors just exiting left, right, and center. So unfortunately, the long-term thesis of this company is just being undermined by something really out of their control. And it's a shame because they were doing very, very good. So unfortunately, this one for me, bit of a no touch. Very, very sad to say, right? So that's pretty much everything that I had to say about that one, guys. And that, I do believe, wraps up our subscriber requests for the week. So thank you very much to each and every one of you who have given me your subscriber requests. Hopefully, I've been able to convey my opinions and thoughts on them correctly and provide you a little bit better insight on them. Just keep in mind, guys, none of this was financial advice, just my opinion on the matter, not meant to be a personal advice for what you should do with the stocks or where to buy or where to sell them. So hopefully you guys enjoyed today's video. If you did, consider dropping a like for the algorithm. Would really appreciate it for the growth of the channel. Consider subscribing to the channel if you're new as well. Would really love to have you here. We do these videos every single Saturday, and then throughout the week, we do our daily market recaps Monday through Friday. So if you want your ticker to be featured in one of these videos, just leave me a comment with that ticker in one of my videos in the upcoming week, and we may just see you next Saturday. And as usual, guys, right, take care, and I'll see you in tomorrow's video. Tomorrow, energy video and top 5 options plays at night. So take care, see you soon, and peace.